Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, March the 18th, 2025, about 7:30 in the morning. Okay, so probably the biggest thing happening today, a lot of stuff happening over in Europe. First of all, geopolitically, we do have a scheduled phone call between Trump and Putin. From a market perspective, I'll leave the politics aside, but from a market perspective, any sort of sense that there's progress towards like a real ceasefire in the Ukraine war is probably going to be sort of positive for European stocks, positive for the euro. A lot of that's been priced in, but the reality is that there's still a war ongoing. And it'd be interesting. There's also risk in the sense that if the market perceives that there's no real progress and that Putin is still holding out for sort of a lot of concessions, who knows? We could see a bit of a reversal of risk and maybe over in Europe some of the sort of the stocks and the euro down itself. But talking about the euro and the stocks, let's just have a look. Euro's been pretty strong here. This is euro US dollar. It's made its way back up to this very, very important level, which is about one, you see on the chart here, about 109.40, something like that, around about here. You see a lot of resistance. So the real question now is that is the euro going to stall out here, or does it have more energy to go sort of further upwards? Obviously, we have the FOMC. Tomorrow they're expected really, well, I'll talk about that in another video. Maybe Powell's expected not to do too much, to be a little bit hawkish, or at least sort of neutral. So they're certainly not going to be hiking interest rates, but they certainly won't be cutting interest rates. Is that going to be massively supportive for the US dollar? Probably not. So I do believe there is the potential here for the euro to push a little bit higher. If we just look at a couple of other technicals, we could maybe just see, let's say, something like the moving averages and Bollinger Bands. So you look at the Bollinger Bands on the daily. The Bollinger Bands have widened up significantly. And so, one could argue from a technical point of view that, possibly the euro has a little bit more upside, maybe to test the top of the Bollinger Bands. As you guys can see, historically, it doesn't really like on the dailies to be too much outside, to close too much outside the Bollinger Bands, just looking all here. So what you can see here is that there's technically a little bit more sort of upside. Let's call it something like 110.70, something like that. That would be, a possibility. If we look at, let's say, the moving averages, you can see that all the moving averages, even the short-term ones, 20 has crossed over the 50. The 50 is about to cross over the 100. So the moving averages are also sort of positive. So yes, from a technical point of view, the euro could have a little bit more upside. If we actually then look across at the stocks, the euro stocks and the German stocks here, and I want to show you guys a couple of charts to put this all in a bit of perspective. We can see that they've basically been doing very well. Here's the Euro Stoxx 50 index, and you can see here that what turned out to be a retracement has turned into pretty strong sort of bull flag. So at this point, just from a technical perspective, the least we can say that is like sort of testing the highs, the recent highs up here. And if you want to do some kind of Fibonacci extension, depending on where you anchor this, but the measured move using the Fibonacci extensions, you're talking potentially another up into some of these zones, another 4.5, 6, even 7, 8% in theory. So the question then is, can this extend? And I think the point is that technically, yes, it can, looking at that. And also looking at a slightly sort of more structural view, which I'll show you a couple of charts in a bit. If we look at the DAX, a similar kind of situation in the DAX, the German index, literally testing those highs again. Can that extend if it breaks out of here? Yes. And today we have pretty soon in the Bundestag, which is the lower houses of parliament in Germany, it looks as though they will have the votes to change the debt brake, so change the constitution to enable all this deficit spending. And that, in theory could lead to more GDP growth and a further extension in the European outperformance. So I just have a couple of things I want to show you. Got some interesting sort of charts pulled together here. So if you look at, just again, this whole question about whether the US is sort of potentially going in the opposite direction to Europe. I don't want to overstate it. Yesterday we had a mixed retail sales. Some of the headline numbers were a little bit soft, but then if you look at the core number, like the control group and the number excluding autos and gas, they're actually quite strong. But then again, the revisions were a bit weaker. So a bit of a mixed position in the US. There are some sort of sort of signs like, just for example, you look at car loans here, 60-day plus delinquency index. So, people, late in paying back their car loans. And you can see here that the prime is okay, but the subprime, the less quality kind of loans are actually sort of heading upwards. And that would seem to follow a lot of the data we're getting, that there's a sort of a K-shaped economy, as people like to say in the US. So you've got, people who are employed with businesses doing pretty well and consuming a lot, people who own assets. So there's a lot of household wealth and asset inflation has occurred. On the other hand, people who are at the lower end of the income spectrum, as you can see here, and maybe sort of feeling a bit more pressure compared to the prime. So quite a big difference here. And we're really seeing in the US a kind of a bifurcated sort of a consumption pattern. So the real question there is, even what tends to happen is that people with lower incomes tend to spend a higher percentage of their incomes on consumption. And so that, but having said that, if they slow down, that's problematic for the economy. But overall, the sort of at the margin, what moves the consumption numbers is the higher income sort of cohort, who seem to be doing okay and still seem to be sort of spending quite a lot and not in any trouble. So it's a mixed picture out of the US. But what we can see over in Germany, and just to put this in perspective, hold on, I'm just trying to. Yeah. So if you look at this sort of infrastructure and defense spending package, just to put that in perspective, you can see, it's talking about as a percentage of GDP up to, 2% of GDP, which is a lot. And just to put that in perspective, if we go back to the 90s and when East and West Germany reunified, which at the time was considered an enormous sort of expenditure of sort of spending, that was about 1%. And then if you look after the Second World War, going back, 60 or 70 years, they had the Marshall Plan, where the US pumped in an enormous amount of money to essentially reconstruct Western Europe. The Marshall Plan comes in at about, 1.25% or so. So in a historical sort of framework and perspective, this is a big deal in the sense that we're talking very large numbers here, 400 billion for for infrastructure, 500 billion for defense, which could also go up. So, the idea is that this will have a large impact on the Germany economy and should sort of filter out to the broader European economy. And then just to sort of back that up and looking at the stocks, you can see ETF flows here. It's pretty incredible. You see like the US focused ETFs. You can see just how much they've come down in billions of dollars. You see on the right hand side, billions of dollars. So a lot of outflows, and you have to assume that quite a lot of those outflows are inflows for the European focused equities, which is sort of this brown sort of line here. So obviously there's sort of some, whichever way you sort of cut the cake, there's definitely sort of flows going out of the US stocks into European stocks. So the question is, can that still go? And what we're seeing here is that Germany is the main beneficiary. So you see here that MSCI index for Europe, excluding Germany, is doing okay in the blue. But you see here, just for the MSCI for Germany, is really outperforming. So Germany is being the prime beneficiary here. Now, then the question is, which stocks, which sectors are doing kind of well? Obviously, you've got here, here's like the expected sort of growth rate down the bottom here, looking over the next sort of, couple of years or so. And you can see here, really, the market's expecting, no surprises here, defense and aerospace really to be sort of super outperforming. This is the price to earnings ratio up here. So really the big outperformers here expecting to be defense and aerospace. So really the question is, if you look down on the lower left, you've got something like automobile industry, which is expected actually to have negative growth. And really is not much expansion in their multiples. So interesting to see, just where, I don't know if you want to do a snapshot here, just to play different sectors. Luxury doing sort of okay, software doing okay, but really a lot of the money seems to have been pumped into this defense aerospace sort of sector, which does make sense if you're starting to talk about spending $400-500 billion. What's also interesting, though, is just to sort of say, well, okay, can this outperformance of Europe and specifically Germany over the US, can that continue? And it looks as though there's plenty of room to run here because they're saying here, just this article I picked up from Bloomberg with this chart, that if you look at this comparison here of the FTSE Eurofirst 300, so this is the broad basket of 300 European stocks compared to the S&P 500, based in sort of euro terms and pound terms. You can see here that Europe has massively, basically for the last 15 or 20 years, underperformed the S&P 500, but all the way down here. So if you actually look at this, one could argue that there's plenty of sort of upside for, money flows to keep on going into Europe, Europeans to basically have some expansion of GDP, and therefore the European stocks to keep on going up. So can the Euro Stoxx 50 and the DAX continue to outperform the US? It would seem so. What's also interesting is that just coming out of the US, as I say, the economy in the US seems to be relatively solid, and we'll get a messaging from that from Powell tomorrow. It does seem to be relatively solid, but it's interesting that the sentiment is starting to weaken. We saw the University of Michigan, which is a very dubious kind of number, but we saw that last Friday that consumer expectations for inflation were very, very high, I think up to 3.9. And then you're getting comments here from Secretary Treasury Bessent, who was just out on the wires like a few minutes ago, literally a few minutes ago. And you see down here, Bessent saying, about the sanctions, but Bessent, no reason for there to be a recession. Okay. But then he says things like, you asking for a guarantee there won't be a recession is silly. So not exactly full of confidence. And essentially, Bessent is really the one leading the way, and Trump himself sort of saying, well, if we get a recession, it could happen. We need to detox. Things are kind of healthy, but hey, a little bit of a detox. So just to say that out of the US, and it does seem we're getting a lot of comments today also from Bessent, really, pushing this date of April the 2nd. And I read through just a few minutes ago, really sort of saying, no, there are tariffs are coming on all countries or most countries. It's going to be variable numbers, variable rates, but it does seem as though in some shape or form there will be tariffs coming, out of the US on April the 2nd, which is what, a couple of weeks away. So really what's going to be interesting is whether the market just takes that as being a negative for the US economy and saying, oh, this is, going to be bad for US companies, or whether this is going to be a dampener on global growth prospects. And we're going to see some of this, relatively good performance recently from Chinese stocks be hit, and obviously over in Europe, whether we're going to see like a global sort of dampening of sentiment. Interesting just to see how that all kind of plays out. And getting back to Europe, of course, all of this spending we've seen. If we look at the yields, we've seen real yields go up. And if we look at things like let's just look at some of these German yields here, we can see that first of all the spread. Interesting for me is that the spread Italy over Germany actually has gone down a little bit, well, not a lot, a basis point or two, but is essentially very sort of stable around about, essentially about a percent or so. So at the moment, the market has pushed up yields equally, but especially in Germany. But Italian yields have gone up 25, 30 basis points, as have French yields. So the point is that the cost of borrowing money has gone up everywhere. Real yields have gone up. So there will be, yes, more sort of fiscal spending, but that's going to come with sort of higher real rates, which should be supportive. All things considered, that's not a bad environment for the euro. And if we look here at the German at the German bonds here, we can see that they've come off a little bit. They sort of peaked out here at about what 2.95 or so, come off a little bit. But you've got to say, if this money in Germany, almost €1 trillion is spent, you'd have to think that, at the minimum, we might retest these highs and then sort of start pushing even above this 3% level. And, some sort of research houses are sort of calling, over the next, 6 to 12 months, maybe even to break out of that and get up towards the next level, which I think is about 3.65. If you go back, I've got it here. Yeah, you go back here, it's about 3.5 or something like that. So there could be more sort of upside in the Bund. So yeah, I think the euro potentially could have a little bit more sort of upside, unless there's some kind of problem. But it's already at an elevated level, so possibly a better pullback. Okay, so that's so much for Europe, and of course we've got the Putin-Trump call, as I mentioned earlier. And let's assume that the spending bill is passed by the Bundestag, sometime today. Leading on to other stuff, just geopolitics, we saw some renewed hostilities between Israel and Hamas overnight. The truce it has been sort of cancelled, so to speak. Again, I'm not going to get into the politics of that, but certainly geopolitical risk there. Allied to that is that the Trump regime the regime also, the Trump administration has suddenly sort of ratcheted up the pressure on the Houthi rebels based, in just near Saudi Arabia there and the Red Sea with a lot of attacks. And basically, Trump has been very clear, essentially signaling that any more attacks from the Houthis will be taken as an attack on US shipping by the Iranians, because the Iranians are essentially sort of funding the Houthi rebels. And there was some sort of talk and stories that an Iranian flagged ship had been sunk by the US. So, all that to say, in terms of markets, this is geopolitical risk in the Middle East, and the potential for new tariffs coming on Iran for oil, and obviously to a lesser extent Israel and Hamas. So we're seeing here that oil has been grinding up a little bit higher. So that's okay. That's interesting on this geopolitical risk here that oil is grinding a little bit higher. But just again, let's all stay calm here, because if we look technically, depending where, let's say, for example, you want to do a fib reversal, you can see from this, I guess, relatively recent impulse downwards, it's about a 38% here. And it hasn't quite broken that. And obviously, if we start drawing the fibs from, anywhere further back or even all this way up here, you suddenly see that this is still a pretty modest reversal. But nonetheless, it is a sort of a beginning. Um, Let's see. Again, the moving average is all pointing downwards still. So could this just be, a little reactive bounce, throwing in a couple of geopolitical headlines, and is oil actually headed downwards? I think, that's going to depend a little bit on the situation with Trump and Putin. It's going to depend a little bit on where the US economy goes, to be honest. And we do have the Fed tomorrow. If the Fed signals that they want to remain sort of on hold, which is very, very, very probable and fully priced in, and slightly maintain a neutral to hawkish stance, that is not great for global growth and specifically American growth. So I'm just looking at this technically here and thinking, rather than some kind of uptrend, is this some kind of subtle, get the crayons out here, some kind of sort of bear flag, and maybe this is going to be rejected along this sort of horizontal level at about 68.70, and at that first 38% fib retracement. And could oil sort of stall out here and maybe even retest the lows and even go lower? Interesting. We'll keep an eye on all of that. In terms of some other stuff, we have the Bank of Japan. They're not expected to hike at this point. There's been a nice little bounce here from the US dollar, but again, that's from a very important sort of fib 61.8 fib retracement level at about the 147. Not a lot to say here. That's going to be a combination of what the Fed does, but again, that's expected to hold tomorrow. So I don't have a lot to say there. I want to get a bit more sort of policy on tariffs and US economic performance, and see what the BOJ does tonight. Something which we can keep a lookout is USD CAD. USD has been falling against the CAD, not a huge amount, but a little bit. What we have today, we have the CPI numbers actually coming up in about an hour or so out of Canada. So if we just look at that here, I think I've got them up here. That's expected here. The main ones which the market likes to look at is the median year over year and the trim number, so like the core number here. And you can see that that's expected to come in at 2.7, 2.8. If that comes in hot, because there was a tax holiday, there was like a sales tax holiday, which the ex Prime Minister Trudeau put on for a few months. That's been lifted now. So the idea is that there could be some higher sort of prices being paid, a bit more inflationary. If this number comes in today or this morning greater than 3%, that could put some downward pressure on USD CAD. So it would be CAD positive. And one of the reasons for that is that recently the Bank of Canada, Tiff Macklem, essentially said that he is fully cognizant of the fact that there are potentially more tariffs coming on April the 2nd, and a lot of sort of trade tension with the US, which would be a net negative for the Canadian economy. but what he said is that that could also bring with it some kind of inflationary pressures. And he did sort of go out of his way to emphasize the fact that they were concerned about inflation, that inflation was still a very important mandate, and sort of signaling to the market that if they had to sort of push between, sort of choose between, higher inflation and stimulating and supporting a weakening economy, they would be tempted maybe to try and maybe not support the economy that much, and they would prefer to keep inflation under control. So putting a bit more emphasis on the inflation controlling mandate. So my point being that if this CPI comes in this morning a little hot, let's say 2.8, 2.9, even over a psychological level of 3% or so. The Canadian dollar could get a little bit of support for that, just based on the fact that the BOC, the Bank of Canada, seems to be pretty squarely focused, not letting inflation get out of control again, even despite the fact that there could be some weakening of the economy if Trump imposes tariffs on April the 2nd. In terms of that, I might leave it there, guys. We've had gold is performing well. Just quickly to have a look at gold again. The geopolitical sort of headlines coming out of, like, U.S. and Iran and Israel and Hamas. We see gold pushing up. It's getting towards the top of that trend line. If we go up on, let's say, the spot price here, you can see that trend level. Very, very strong performance last 2-3 days here. What are we at now? 3,026. So really, it's cleared the 3,000 level pretty convincingly. And you've got to say the next target, probably from a technical perspective, is the top of this sort of channel, up at, let's say, 3,050 or so on the front futures contract, maybe about 3,000, or similar, kind of 3,050-ish. Just keep in mind in terms of the stocks, we see the Euro stocks doing pretty well. The VIX down in the US, so volatility is coming down. That ordinarily should be a support. One thing I would mention is that the US stock equities had a little bit of a bounce, but as you guys can see here, this is the cash SPX stalling out on the 200-day exponential moving average here and actually being rejected. So again, if we look at, let's have a look here and draw some fibs, we can see that if we take this move here, we didn't get anywhere near even like a 38% fib retracement, and we certainly didn't get up towards this 57, 5800 kind of level. What we did do is to get up to the 5700 level, which, as we signaled, I think yesterday, you see it's a pretty important resistance point and kind of failing at the 200-day EMA. If we look at the ES, just keep in mind that we do have the futures roll. So this looks like a jump gap. But actually, it's just the futures roll kind of gapping upwards. Really, what's going to be important, and it's kind of interesting when you have a futures gap roll, like a roll gap, is just technically how the market reacts. Because if the market wants to be bullish, it can take this as a kind of a new sort of support level and keep on going. On the other hand, if it wants to be bearish and signal bearishness, it will pretty quickly, as a first order of business, come down and try and fill the roll gap kind of thing. So it's pretty interesting just to look at this, see what happens over the next few hours between 56.77 and, let's say, something like 57.30, which is essentially this gap here. But again, what you can see is that, more or less on the futures, the 200-day moving average, if you look across to NASDAQ on the cash one, it couldn't even muster up a bounce up to the 200-day EMA. So the point is that the US stocks are weak, and you compare this price action, and just to remind ourselves of what's been going on, let's say, over in Europe, very, very different sort of charts. So yes, it does look as though this rotation and this sort of this story of US exceptionalism sort of going down and Europe becoming sort of the new sort of favorite thing, it does seem to be continuing. And we have to say that if, assuming the spending bill is passed in Germany today, and potentially some kind of progress with Trump-Putin, that could be another bit of positive sentiment. Okay, guys, so I'll leave it there. Have a great day. Let's keep it headlines. Anything from Mr. Bessent out of the US, also Trump-Putin. And in the US, there's not really any particular data today, if my memory serves me correctly. Of course, hopefully later today, or certainly tomorrow morning early, I will be doing a FOMC kind of preview. Again, they're not expected to cut or to hike, so really it's going to be a little bit about the dot plots and the messaging in the press conference. That's really what should get the market moving or not. Okay, have a great day, and thank you very much.